A stock trading at $2.43 isn't where most investors look for exposure to enterprise AI infrastructure. But this company is positioning itself around high-performance compute systems tied directly to GPU acceleration, the same backbone powering large-scale AI model training and next-generation data center expansion. That's the tension immediately. A sub-$3 stock connected to one of the most capital-intensive layers of artificial intelligence deployment. Here's the interruption. While companies tied to the GPU supply chain and AI hardware cycle command multi-billion-dollar valuations, this one sits at a fraction of that visibility. And it's doing so at a time when enterprise compute demand is still expanding. But there's a reason the market hasn't rewarded it yet. This company focuses on compute infrastructure, specifically systems designed to support accelerated workloads. In practical terms, that means hardware configurations optimized for AI training, inference tasks, and high-performance data processing. Instead of building consumer gadgets or abstract software tools, it operates closer to the backbone layer, the machines and platforms that allow AI models to actually run at scale. These systems matter because AI isn't limited by ideas. It's limited by compute. Training large models requires dense GPU clusters, optimized cooling, power efficiency, and system-level engineering. Enterprises adopting AI internally, from financial institutions to logistics operators, increasingly need scalable hardware environments rather than scattered single-server setups. So the real-world deployment angle isn't theoretical. The demand driver is enterprise modernization. Data centers upgrading racks for accelerated compute. Businesses integrating AI workflows that require dedicated infrastructure. Government and regulated industries seeking localized processing environments. That's the relevance. But here's the quiet question underneath it. If the exposure is connected to GPU infrastructure, why is the stock still sitting under $3? Zooming out, the broader AI cycle has been uneven. Large-cap semiconductor leaders have absorbed most investor attention. Companies directly manufacturing advanced chips have seen explosive multiple expansion. Meanwhile, secondary layers of the ecosystem, integrators, system builders, infrastructure intermediaries, often trade at much smaller valuations, even though they participate in the same deployment wave. This creates a structural gap. Capital floods to the headline names. The surrounding infrastructure layer receives less visibility, even though it may benefit from enterprise rollout cycles over a longer period. The company's monetization model sits within that infrastructure layer. Revenue typically ties to hardware systems, compute configurations, and enterprise contracts. Instead of depending on consumer demand, it aligns with institutional purchasing cycles, which are slower, but often larger in ticket size. That can be both strength and weakness. Strength, because enterprise contracts can create recurring demand and long-term relationships. Weakness, because growth may appear uneven quarter to quarter. And markets tend to reward visible acceleration more than steady infrastructure positioning. There's another layer here, scale perception. When investors evaluate AI exposure, they often default to chip designers or hyperscale cloud operators. Smaller compute-focused firms can be perceived as peripheral, even if they serve enabling roles inside deployment pipelines. But enabling roles are exactly what matter during expansion phases. As AI workloads shift from experimentation into operational integration, enterprises require physical infrastructure upgrades. That's not optional. If AI adoption continues at current trajectories, compute density and hardware optimization become central investment categories. Still, the stock hasn't reflected that narrative. At this point, it's time to name the company. The business is Axe Compute Inc., trading under the ticker AGPU, with shares currently around $2.43. At this price level, the entire valuation sits in a range that often attracts speculative retail traders rather than institutional analysis. That perception alone can suppress attention. Sub-$5 stocks frequently face liquidity constraints, volatility spikes, and limited analyst coverage. And that's where part of the discount may originate. Smaller companies operating in infrastructure layers often struggle with scale visibility. Revenue concentration, evolving margins, or capital requirements can introduce uncertainty. Hardware businesses, in particular, face challenges around sourcing components, managing inventory, and competing against larger system integrators. So the market may be pricing in execution risk rather than dismissing the industry theme. That distinction matters. Because if enterprise GPU expansion continues through 2026 and into 2027, driven by AI model deployment, private data center upgrades, and hybrid compute environments, companies positioned within the hardware backbone layer could see increased relevance. But timing is everything. If expansion cycles accelerate, infrastructure providers may benefit earlier than expected. If capital spending slows, smaller firms feel pressure faster than large incumbents. So the opportunity thesis isn't about hype. It's about alignment with a capital expenditure cycle tied to AI compute scaling. And that cycle is still unfolding. From a forward-looking perspective, potential catalysts would likely involve contract announcements, revenue acceleration tied to enterprise deployments, or strategic partnerships within the GPU ecosystem. Even improved visibility around backlog or repeat customers could shift perception. However, risks remain real. Hardware markets are competitive. Margin compression is possible. Larger players can absorb pricing pressure more easily. Access to components and supply chain dynamics can impact delivery timelines. And small-cap stocks carry volatility that larger semiconductor firms do not. This brings us back to the opening tension. At $2.43, the stock reflects uncertainty more than dominance. It trades in a price bracket many investors dismiss outright. Yet it operates in a segment tied directly to AI infrastructure, not peripheral software themes, but compute systems that enable model training and enterprise deployment. The key question isn't whether AI will require hardware. It already does. The real question is whether smaller infrastructure participants can scale alongside the enterprise GPU expansion cycle, and whether the market eventually assigns them visibility proportionate to their role. There are no guarantees here. This is not a prediction of explosive upside. It's an examination of positioning versus perception. A sub-$3 stock linked to enterprise compute expansion represents asymmetry only if execution improves and capital cycles remain supportive. If not, the discount persists. Understanding that balance, between infrastructure relevance and execution risk, is where the real analysis sits. This discussion is for educational purposes only and not financial advice. The objective is to evaluate how a lower-priced company connects to enterprise AI infrastructure, where it fits in the GPU-driven compute ecosystem, and why its valuation may differ from more visible semiconductor leaders. In AI markets, the most obvious names capture attention first. Sometimes the deeper layers of infrastructure take longer to be recognized, if they ever are.